to the section 37 of my channel in order flow with Ethan. My name is Ethan. I've been trading the order flow for roughly 4 years now, and here am I on the internet explaining to you how it works from A to Z. So today we'll be talking about the order flow's hidden trade opportunities. It's going to be an interesting video where I'm going to explain a lot of different topics that would help you guys find hidden trade opportunities while trading the order flow. These are three simple patterns that I've explained before, but I will go deeper today and help you spot those trades, spot those opportunities as they happen in the market. So order flow charts tell the actual story of what is happening in the market, as it shows you the actual trades by the market participants. Traders often get lost in complex indicators, but price is ultimately driven by one thing: supply and demand, while the indicators like RSI and MACD tell you what happened. Supply and demand tell you why it's happening. In economics, the law of demand is a proven fact. When demand for an asset accelerates, price must rise, but when demand for an asset decelerates, then price must go down. So the law of demand and supply works on every single thing, every single market in the world. So same thing goes back to trading markets, trading stock markets also. So you just have to analyze the supply and demand of the market so you can actually understand what is happening and where is the market going to next. So the first setup I'm going to talk about is a trap trader's imbalance. This setup occurs when there is a buying imbalance at the top of a bar that closes lower. For example, this red candlestick with a buying imbalance at the top, and when there is a selling imbalance at the bottom of a bar that closed higher than it opened. Okay, so imagine here we had a green candle with selling imbalance at the bottom. So how do we trade this setup? You should identify, well, let me explain first of all what actually happened in this setup. So those are basically trap traders. As you can see, they have bought the high of the market. So these people are liquidity of the market. So for the price to reward other people, we need to get some people to lose money. That's how it works here, and we need liquidity in the market so the markets can move. So all of these traders got stopped at one point, and this is maybe their stop loss is being hit, or their take profit could also be their take profit, but it's not possible. So it should be their stop losses, and also maybe people who just decide to enter at the highest point in the market. The market suddenly goes down, and all of those traders get simply trapped. So how does it work? First of all, you should identify buying imbalance at the top of a price bar that marks a new high. It shouldn't be the highest of the market, but it just could be the high of a swing, for example, let's say. So ensure the bar closes lower than it opened to confirm that buyers are trapped at the peak of that candlestick. Wait for the bar to fully close before entering to prevent being trapped by a mid-bar reversal. Enter the trade by selling at the market or scaling into the setup bar to ensure you catch the downward move. Maybe your entry should be at the POC level, and your stop loss should be basically 2 ticks above the buy imbalance price to invalidate the trade if the high is breached. Then you should set a fixed profit target or exit early if the market conditions change, or if a reversal signal appears. For example, delta turning to be more positive and the market just reversing quickly. So every time a trap trader setup happened, the market gives small profit first if you go and sell, but then conditions changed. It could keep going down, or maybe it would quickly reverse to go up again, and that's where you probably will get your stop loss being hit, although you had probably made some profit. So that is why whenever you see conditions changing, just make sure to exit as soon as possible so you don't get stopped. So next setup is the single prints. This setup occurs when there is a single print at the high and the bar closed lower than it opened, or when there is a single print at the low of a bar and the bar closed higher than it opened. A single print is on a single digit volume number, like from 1 to 9, traded at the low of a bar that closed higher, or when a single digit traded at the high of a bar that closed lower. So this is too complicated. Let me explain it to you. For here, for example, you can see we have this red candlestick. We have a single print here at the top of a red bar, which is a buying single print here, for example, with a big imbalance, 344 against 1. Same thing here. Once again, we have a single print, so 1 1. It shouldn't be 1 exactly, it could be 7 5 4 up to 9. Even 11 and 12 counts because that's still a low number, okay? But single prints usually should be around from 1 to 10. That's when we highlight it. So every time you see such a highlight here, because we installed it on the software system, on the software for you guys, so you can see it when you're trading the order flow. So the concept behind this trade setup is that the last buyer has bought at a high, or the last seller has sold at a low. Literally, the last buyer has bought or seller has sold. There is no more interest by traders to move the market any higher or lower. So here, for example, as you can see, that's a green candlestick. We have one contract that was sold at this point against 38 contracts that were bought. 6 here, 2, 9, 9 once again. So you can see this one wasn't highlighted because we still have a green candlestick. So the one that will be highlighted like this is when we have a buy in single print at a red candlestick. It should be highlighted green when it's a selling single print at a green candlestick. So you can see it's highlighted as green. That means it's positive for buying. When it's red, it's positive for selling. So here, for example, we have 6 because it's a red candlestick. Here we have 2, but it won't be highlighted on the order flow because it's a green candlestick. But here again, it was highlighted because it's 6. It's a selling imbalance single print. It's a selling single print because it's a green candlestick. But here it cannot be highlighted because it's a green candlestick and it's a buying single print at a green candlestick, so it doesn't count. It should be against the candlestick. So how do we trade this? First of all, you gotta spot the print, locate a single print at a bullish bar's bottom or a bearish bar's top, preferably at swing extremes. Then you gotta wait for the close. Enter only after the bar finishes to ensure the single print remains valid. You should also not take any single trade you see. Please make sure to find other confirmation zones because these are just confirmations in the end. You gotta get a lot of information together before taking a trade. Then put a tight stop, place your stop loss, one tick outside the print. If price hits it, the setup is dead. Then take a set profit or exit immediately if the market environment shifts. So the last setup we'll be talking about is the stacked imbalance zones. This setup occurs when there are 3 or more stacked imbalances in a bar. A zone is extended out on the chart to highlight this level. These are great levels to trade off when the market retraces into them. So stacked imbalances create strong support or resistance levels because they mark areas of aggressive institutional activity. While consecutive imbalances can be noisy, they highlight where big players are committed. Long entry, you should buy when the price retraces back into a stacked buying zone and watch how the price reacts. If you should treat it as a support or resistance zone. If the price starts being more positive when we go to that level again, then that's a good buy signal. When we go to a stacked selling zone and you see again new selling imbalances happening at that level, then that's a good entry for a short position, only if you have more confirmations. Okay, so how do we trade it? You should just identify the stack, look for at least 3 consecutive buying or selling imbalances within a single bar, trade the retest, like trade stacked buy zones as support and stacked sell zones as resistance. Enter only when price retraces back into the area, and especially when you see a confirmation. Don't just go and think, oh, this guy told me on YouTube, yeah, whenever the price goes back to the stacked imbalance zone, I should trade it. Well, let's see what happened here. Yes, this was positive. As you can see, the price went back to this level. It gave us a single print and also a imbalance here. As you can see, that's an imbalance 16 against 5, and the price immediately went down, although it was still a green candle. But this is the market of crude oil, which is very volatile. If you trade it, please do pay attention. Same thing again here, we came back to that level, the price gave us a single print at the top, and then it kept going down. Same thing here, price went back to that level, quick correction, give us a single print and an imbalance, and then it went up. So yes, try to look for these. Look for single prints to happen, new imbalances, and positive delta, also related to the market context. So then you should set the stop one tick outside the zone. though you can allow 2 to 3 ticks for more volatile markets like the S&P 500. What I like about these hidden trade opportunities is that they are easy to spot and they happen multiple times in the market every single day. You just have to choose the high quality ones and look for perfect entries, because order flow trading is not for everyone, but I think it is a useful skill and a tool for traders to really understand if they really want to succeed in their trading. So thank you guys for your time watching this video. I hope you got some information, and please do let me know in the comment section if you got any questions. This was Ethan from Order Flow with Ethan. Thank you and have a great day.